If you looked at silver lease rates this morning and saw 41%, you need to understand something immediately. You're not witnessing normal market stress. You're witnessing the early stages of a physical delivery crisis. And what this number actually means is far more important than the silver price you see on your screen. Ladies and gentlemen, Asian Guy here. Today is Wednesday, February 11th, 2026. And what happened overnight while most traders were focused on the spot price was a quiet escalation in a metric that almost nobody tracks, but everyone should understand. Silver lease rates crossed 41% for the first time since this crisis began. For those who don't know what lease rates are, let me be very clear. This is not a complex derivative or an obscure indicator. This is the interest rate that banks pay to borrow physical silver for short periods of time. And when that rate goes from 1% to 41%, it's not volatility. It's a distress signal. What I'm about to show you is not speculation. It is the documented mechanism of how physical shortages manifest before prices fully reflect the shortage. It is the warning system that precedes explosive moves, and it is the reason why silver at $78 today will look impossibly cheap within weeks. We are going to break down exactly what lease rates measure. We are going to explain why 41% is structurally alarming. We are going to show you what happened the last two times lease rates crossed 40%. And we are going to connect this to the physical supply crisis unfolding right now. Let's dig in. Let me take you inside the machinery. Silver lease rates measure the cost of borrowing physical silver from holders who own metal and are willing to lend it for a fee. Think of it like an interest rate, but instead of borrowing dollars, you're borrowing silver bars. Under normal market conditions, lease rates trade between 0.5% and 1% annually. That's the baseline. When a bank needs to borrow silver temporarily to fulfill a delivery obligation or facilitate an industrial client's purchase, they pay a small fee. But when lease rates spike above 5%, something is wrong. When they cross 10%, something is very wrong. When they reach 20%, the market is experiencing severe stress. And when they cross 40%, it means institutions are willing to pay almost any price just to access metal for short periods. Current lease rate, 41% annually. To put that in perspective, if you borrow 1 million ounces today and return it 1 year from now, you owe an additional 10,000 ounces in interest. That's not a cost you pay unless you're desperate. This tells you everything about the physical market. Banks don't pay 41% to speculate. They pay 41% because they need metal to fulfill obligations and cannot source it any other way. The spot price on COMEX closed yesterday at $78.42. That's the paper price. But the lease rate tells you that the real cost of accessing physical silver is $78.42 plus a 41% annual borrowing cost. That's the true price of physical availability, and it's diverging dramatically from the paper quote. The two historical precedents. Now let me show you what happened the last two times silver lease rates crossed 40%, because the pattern is unmistakable. May 1999. Lease rates hit 40%. In late April and early May 1999, silver lease rates spiked to 40%. The catalyst was massive short covering by institutions who had sold silver they didn't own and suddenly needed to deliver physical metal. The shortage was so severe that the lending market froze. What happened next? On September 26, 1999, the Washington Agreement was announced. Central banks from Europe agreed to limit their gold and silver lending to stabilize markets. Within weeks, silver began a multi-year bull market. Silver went from $5.50 in September 1999 to $21 by February 2008. That's a 280% gain over 8 years that started with a 40% lease rate spike. The lesson: when lease rates hit 40%, the physical market is broken. And when the physical market breaks, authorities intervene. And when interventions happen, prices adjust violently higher. October 2008, lease rates hit 30% plus. During the financial crisis, silver lease rates spiked above 30% as liquidity seized. Banks that had lent silver suddenly wanted it back. Industrial users couldn't source metal at any price. The paper market quoted $9 while physical dealers charged $15 to $18 with 6-week delays. What happened next? Silver bottomed at $8.88 in November 2008. Then it rallied to $49.80 by April 2011. That's a 460% gain in 2.5 years. The lease rate spike marked the exact bottom and the start of the most explosive silver bull market in modern history. The lesson: Lease rate spikes predict structural breakdowns that lead to massive price dislocations once the market realizes physical metal cannot be accessed at paper prices. February 2026. Lease rates at 41%. We are now in the third occurrence of 40% plus lease rates in modern history. But this time is different. In 1999 and 2008, lease rates spiked quickly, then crashed back to normal within weeks. The shortage was temporary. This time, lease rates have been above 30% for 28 consecutive trading days. They've been climbing steadily, 35% on January 20th, 38% on January 29th, 39% on February 5th, 41% as of February 10th. This is not a spike. This is sustained elevation. This is not temporary stress. This is structural breakdown, and the longer lease rates stay this high, the more certainty you have that the physical shortage is real, worsening, and about to force repricing. Why banks pay 41% to borrow silver. Now let me explain why institutions are paying 41% to borrow metal, because understanding this reveals how dire the situation has become. There are three primary reasons. Reason 1, short covering. A bank sold silver futures at $70. Price rose to $85. They're underwater. When the contract approaches delivery, they need physical metal or must buy back at a loss. If they can borrow metal temporarily, they deliver it against the contract, close the obligation, and hope to acquire replacement metal later. They pay 41% because it's cheaper than buying at spot to close the short. Reason 2, industrial client facilitation. A major solar manufacturer calls and says, "We need 2 million ounces within 10 days or our production line shuts down." The bank doesn't have 2 million ounces. They borrow from someone who does, deliver to the client, and hope to source replacement metal later. They pay 41% because losing the client relationship is more expensive. Reason 3, delivery obligations from allocated accounts. Wealthy clients request physical delivery. When multiple clients simultaneously demand delivery, the bank may not have enough segregated metal immediately available. They borrow to fulfill delivery while waiting for replacement metal. They pay 41% because failing to deliver destroys client trust and triggers legal liability. All three scenarios have one thing in common. The bank needs physical metal now. That desperation drives lease rates to 41%. Now let me show you why lease rates matter more than spot prices by examining what physical metal actually costs. Shanghai physical silver $122 per ounce. That's a $43.58 premium over COMEX. Dubai physical silver $118 per ounce with 2 to 3 week delivery delays. Tokyo physical silver $159 per ounce with 1 to 2 month waiting periods. U.S. retail dealers, American Silver Eagles at $94.98, generic rounds at $86.90. Perth Mint, suspended new silver sales January 28th. U.S. Mint, suspended Silver Eagle production February 3rd, citing unprecedented demand. Royal Canadian Mint, delivery times extended from 2 to 3 weeks to 8 to 12 weeks. The paper market says $78. The physical market says $95, $122 depending on location. That's a 22 to 56% divergence, and lease rates at 41% are the bridge between those prices. They show you the true cost of accessing physical metal when you need it immediately. Let me explain why this creates a ticking time bomb. Industrial users don't care about paper prices or lease rates. They care about one thing: can I get the metal I need when I need it? Industrial silver demand reached 520 million ounces in 2025. That's 61% of total global supply. And it's not optional. Solar manufacturers need silver paste for photovoltaic cells. China is deploying 200 gigawatts of new solar this year. That's 160 million ounces that must be sourced regardless of price. Electric vehicles use 25 to 50 grams of silver each. With 25 million EVs projected this year, that's 55 million ounces of non-negotiable demand. 5G infrastructure requires silver in every base station, another 30 million ounces. AI data centers need massive electrical infrastructure, another 25 million ounces. That's 270 million ounces from just 4 sectors, 32% of global annual production. And none of that demand is elastic, none adjusts downward when prices rise. What happens when industrial procurement teams discover their suppliers can't deliver at $78? They panic. They secure supply at any price. They shift from price-sensitive to price-insensitive. That shift is happening now. Now let me show you why this shortage cannot resolve quickly. Global silver mine production, 850 million ounces per year. That's been flat for 5 years despite silver prices doubling. Why? Because over 70% of silver comes as a byproduct of copper, zinc, and lead mining. Silver supply responds to base metal economics, not silver economics. Primary silver mines account for only 30% of supply. Many were marginal for years due to price suppression. Even now, bringing new mines online takes 5 to 7 years minimum. Discovery, permitting, financing, infrastructure. None happens quickly. Recycling adds 150, 180 million ounces annually, but most silver is consumed in applications where recovery is uneconomical. A solar panel contains 20 grams dispersed across the module. Recovering it costs more than the silver is worth. This creates a structural deficit of approximately 200 million ounces per year, 4 consecutive years of deficit, and the buffers that absorb those deficits are depleting. COMEX registered inventory, 32 million ounces, down 29% in 6 weeks. Shanghai Futures Exchange, 350 metric tons, 11.25 million ounces, down 26% in 3 weeks. London LBMA vaults, estimated outflows of 15-20 million ounces in January alone. The vaults are draining. And lease rates at 41% are screaming that the shortage is real. Let me address what mainstream analysts refuse to discuss. China imported 200 million ounces in January 2026 alone. That's more than 20% of annual global production in 1 month. Where is that metal going? Strategic government reserves, solar manufacturing stockpiles, battery production facilities. This is not temporary. This is national policy. China understands renewable energy requires silver. They understand semiconductor independence requires silver. They understand hard assets matter in a multipolar world, so they're securing those assets now. And here's the critical detail. Metal flowing into China doesn't come back out. It gets consumed in solar panels. It gets vaulted as strategic reserves. It exits the available supply pool permanently. Every time silver dips, Chinese buyers step in, not to speculate, to secure supply. That buying is relentless and price insensitive. They see 41% lease rates as confirmation of supply stress. Let me show you why mining companies' behavior proves this shortage is structural. If mining executives believed 41% lease rates meant imminent price collapse, they would hedge future production aggressively, lock in prices, issue warnings, cut capital expenditures. None of that is happening. Major silver producers are not hedging. In fact, several are expanding production capacity. They're acquiring new projects. They're investing capital as though $80 silver is sustainable or conservative. Mining is a 5 to 10 year business. Executives don't react to daily volatility. They react to multi-year demand forecasts, cost trends, and supply constraints. And when you look at those factors, the picture is clear. The people who actually produce silver believe the shortage is real. They believe demand will remain strong. They believe prices will stay elevated or move higher, and they're allocating capital based on that conviction. If the producers aren't worried, why should holders be worried? Let me show you the timeline, because lease rates at 41% are the early warning system. If lease rates stay above 35% for another 2 weeks, industrial buyers will begin panic procurement. Just-in-time strategies will shift to buffer stock building. Price sensitivity will decline as availability becomes the only concern. If lease rates climb to 45-50%, it signals imminent delivery failures. That's when exchanges implement emergency measures, margin increases, delivery restrictions, cash settlements, all of which destroy paper market credibility. If lease rates stay elevated through March delivery period, begins February 25th, we'll see the first major test of whether COMEX can fulfill physical delivery at scale. Eventually, one of two things happens. Outcome 1, authorities intervene, like the Washington Agreement in 1999. Mining nations boost production. Central banks lend reserves. Exchanges restrict speculation. All of which confirms the shortage was real and leads to higher prices. Outcome 2, the paper market breaks. Exchanges declare force majeure. Physical and paper prices permanently disconnect. Silver trades at 2 prices, $80 paper that nobody can convert, and $130 plus physical that reflects actual availability. Both outcomes are bullish for physical holders. Both are catastrophic for paper traders. And lease rates at 41% tell you we're closer than most realize. Let me give you the framework for navigating this. If you hold physical silver, do nothing. You own the scarcest asset in a supply-constrained market. Every day that lease rates stay above 35% confirms your thesis. The paper price is noise. The lease rate is the signal. If you're considering buying, understand what you're buying. Paper silver, ETFs, futures, unallocated, might give price exposure but not metal. Physical silver, coins, bars, allocated storage costs more due to premiums, but it's what you can hold when the paper market fails. 41% lease rates tell you that spread is rational. If you're trading, your stop loss should be below $75. That's the level where the structural story breaks. Above that, every dip is a shakeout, not a trend change. Use lease rates as confirmation. If rates stay above 35%, buy dips. If rates collapse below 20%, reassess. The key is separating paper price action from physical market reality. The paper market can remain irrational, but the physical market cannot create metal that doesn't exist. 41% lease rates are not a price prediction. They're a structural diagnosis. They're telling you the patient is sick, and the sickness doesn't resolve with volatility. It resolves with repricing. Silver closed yesterday at 78.42. That's the number everyone watches. But that's not the number that matters. The number that matters is 41%. That's the interest rate institutions are paying to borrow physical metal. And that number is screaming that the physical shortage is real, acute, and worsening. This has happened twice before, May 1999 and October 2008. Both times 40% lease rates preceded massive bull markets. Both times the spike marked early stages of supply crisis that forced price adjustment. But this time is different. In 1999 and 2008, lease rates spiked and fell within weeks. This time, they've been elevated for 28 consecutive days and climbing. This isn't temporary, this is structural breakdown. The vaults are draining. Shanghai down 26% in 3 weeks. COMEX down 29% in 6 weeks. London bleeding 15-20 million ounces in January. And lease rates at 41% are the market's way of saying, we cannot find metal at current prices. Industrial buyers don't care about lease rates. They care about availability. And when availability becomes questionable, they shift from price-sensitive to price-insensitive. They secure supply at any cost. That shift is happening now. Mining companies see it. They're expanding, not hedging. China sees it. They imported 200 million ounces in January. Physical dealers see it. Premiums at 10-50% over spot. The only group that doesn't see it yet is paper market participants who still trust that $78 means they can access physical at $78. That trust is about to be tested, and when it breaks, the repricing will not be gradual. 41% lease rates are not telling you to panic. They're telling you to pay attention. They're telling you the rules are changing. They're telling you paper and physical are disconnecting. And they're telling you that time is running out to position on the right side. I am the Asian guy, and I'm watching lease rates more closely than price. Because price tells you where we are, lease rates tell you where we're going, and at 41%, we're going somewhere that will shock people who only watch the paper price. Thank you for being part of this community. We don't follow the crowd, we follow the signals that matter, and we position based on structural reality, not paper fiction. Remember to like, subscribe, and share this video. The next phase belongs to those who understood what 41% actually means. See you in the next one.